In today's video, we'll explore Canadian REIT ETFs, breaking down what they are, their advantages, and we will drop 5, of course, for your due diligence. Whether you're a seasoned investor or just starting out, this video will help you better understand this unique investment opportunity. Fasten your seatbelts, this is going to be a good one. REIT stands for Real Estate Investment Trust, which is a company that owns, operates, or finances income-producing real estate properties. REITs allow individual investors to benefit from owning shares in these properties without having to buy, manage, or finance them directly. A REIT ETF is a type of investment fund that holds a diversified portfolio of, well, in this case, Canadian REITs. By investing in a REIT ETF, you get exposure to a broad range of real estate assets across Canada, allowing you to benefit from the income and potential appreciation these properties are going to generate. There are several advantages with these REIT ETFs. First, they offer diversification as you're investing in a basket of REITs rather than a single property or company. This helps spread your risk and potentially reduce the impact of any single underperforming asset. Second, they provide a regular income stream as the underlying REITs like to distribute a significant portion of their income to their shareholders, usually, of course, in the form of dividends. This makes them an attractive option for income-focused investors. Third, it is a more accessible and cost-effective way to gain exposure to the Canadian real estate market than purchasing, of course, individual properties. This is especially true for smaller investors who may not have the capital to buy real estate directly. And finally, REIT ETFs are traded on stock exchanges, which of course makes them highly liquid investments. This means you can easily buy or sell shares in a REIT ETF just like you would with any other stock. Join the conversation. Let us know in the comments if you currently hold any REITs. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. There are not a lot of REIT ETFs on the Canadian market, though I suspect that could change as ETFs continue to grow in popularity. For today's list, I have chosen 5 REIT ETFs for you to take a look at, and I have ranked them by their dividend yield. So without any further ado, let's do this. Kicking off this list, we have Invesco S&P TSX REIT Income Index ETF with a ticker of REIT. This is an ETF that seeks to replicate the performance of the S&P TSX Capped REIT Income Index. And I bet there's a few REITs out there that wish they could have gotten that ticker. Their net assets come in at $20.46 million, and they've got a fairly stable beta of 1.16. Their NAV comes in at 19.79, and they've got a price to earnings ratio of 7.18. Their return on equity, that comes in at 9.95%, and the management fee for this REIT comes in at 0.48%. Moving to their returns, their dividend yield comes in at 4.419%. That's paid out monthly in the amount of 8.1 cents per share. Switching over to growth, their 3-year return on investment came in at 15.36%. You factor in the dividends, and we get a total return of 32.63%. I will warn you ahead of time, REITs have not performed well in the bear market, so we will see some negative numbers here today. So their 1-year return on investment, it came in at negative 22.36%. Adding in the dividends, we get a total return of negative 18.94%. Now that is worse than the TSX. In the last 1 year, the TSX has a return of negative 11.38%. So they have done a lot worse than the TSX. Let's switch to 2023. The return on investment, it comes in at 0.25%, and they have a total return in 2023 of 1.07%. Okay, coming in at number 4, we have Vanguard FTSE Canadian Capped REIT Index ETF with a ticker of VRE. This ETF seeks to track the FTSE Canadian All-Cap Real Estate Capped 25% Index. Their net assets come in at $330.2 million, and they have a beta of 1.23. Their NAV, that comes in at 29.06, and their price to earnings ratio comes in at 8.29. Their return on equity, that comes in at 9.16%, and they do have a management fee of 0.35%. When we move to their yield, their dividend yield comes in at 4.47%. That is paid out monthly in the amount of 6.7 cents per share. This is a dividend that has had a significant drop. They used to have a dividend of 9.4 cents per share. So you need to certainly take that into consideration when you do your due diligence on this one. Looking at their returns, their 3-year return on investment, that comes in at 21.00%. Adding in the dividends, we get a total return of 35.33%. Their 1-year return on investment comes in at negative 20.46% for a total return of negative 16.91%. Once again, they did a little bit worse than the TSX over the last year. In 2023, their return on investment comes in at 0.41%, and that gives us a total return of 0.87% after we factor in those dividends. I do overall like Vanguard, and I'm pretty sure that this one is going to bounce back when we move into a more bullish type market. Taking our third spot, we have the BMO Equal Weight REITs Index ETF with a ticker of ZRE. With this fund, BMO seeks to replicate the performance of the Selective Equal Weight Canada REIT Index. They've got net assets of $653.95 million. They've got a pretty stable beta of 1.17, and their NAV comes in at 21.40. Their price to earnings ratio, it comes in at 6.40, and their return of equity comes in at 13.45%. They've got a management fee of 0.55%. Switching to their dividends, they have a yield of 4.66% that's paid out monthly in the amount of 9 cents per share. When we look at their returns, their 3-year return on investment, they had 23.09%. Add in the dividends, we get 41.49%. Once again, we're going to see a 1-year ROI that doesn't look too great. They came in at negative 22.92%. Factoring in the dividends, we get a total return of negative 19.03%. They did worse than the TSX as well. In 2023, their return on investment has come in at negative 2.17%, and we get a total return of negative 1.36%. These are not great numbers, but I really do like the BMO ETFs. So once again, this is another one I feel very confident is going to rebound well once we do move back towards a bull market. In our almost top spot at number 2, we have CI Canadian REIT ETF with a ticker of RIT. This ETF seeks long-term total returns from an actively managed portfolio comprised primarily of securities of Canadian REITs. Their net assets come in at $640.78 million. They've got a stable beta of 1.11. Their NAV comes in at 16.00, and they have a price to earnings ratio of 5.50. Their return on equity comes in at 14.55%, and they've got a management fee of 0.75%. When we look at their dividends, they have a yield of 5.04%. That is paid out monthly in the amount of 6.8 cents per share. Their 3-year return on investment comes in at 13.33% for a total return of 30.59%. When we switch over to 1-year return on investment, we get negative 23.59% for a total return of negative 19.71%. And once again, we are underperforming the TSX, as we have pretty much in every single one of these thus far. In 2023, their return on investment came in at negative 0.37%, and that brings us a total return of 0.47% once we add in their dividends. In our top spot at number 1, we have Harvest Global REIT Leaders Income ETF with a ticker of HGR. This ETF invests in top REITs and also writes covered calls on up to 33% of their holdings to maximize those returns for their shareholders. Their net assets come in at $12.67 million, and they have a beta of 1.16. Their NAV, that comes in at 6.15, and they have a price to earnings ratio of 14.01. Their return on equity, it comes in at 13.21%, and they have a management fee of 0.85%. When we look at those dividends, their yield comes in at 8.836%, and that's paid out monthly in the amount of 4.6 cents per share. You can definitely see that the covered calls helped enhance that yield a good bit. When we look at their returns, oh dear, their 3-year return on investment actually comes in at negative 18.81%. Now, that giant dividend does help out because that brings a total return up to 3.13%. It's still not great. That 1-year return on investment comes in at negative 32.71%, and that's a total return after we add in the dividends of negative 26.65%. In 2023, their return on investment comes in at negative 9.05%, and that gives them a total return of negative 7.69%. There is absolutely nothing in these returns that you can get excited about. This is one whose returns is a little more concerning than the others. I would be careful with this one without a doubt. Before investing in a REIT ETF, there are several factors you should consider. First, evaluate the ETF's holdings to ensure they align with your investment objectives and, of course, your risk tolerance. Some REIT ETFs may be more heavily weighed towards specific property types, such as retail, office, or residential, which can impact the fund's performance. Also, consider the ETF's fees and expenses, as they can have a significant impact on your overall return. These REIT ETFs we looked at today have a solid diversification into the real estate sector and generally not too bad returns. They have suffered big time though with the bear market, but that is kind of normal for a REIT. For those of you who are looking for those really high returns, REITs are not really designed for those uber high yields, but they can return some growth and they can definitely be a steady supply of dividends, which of course is not too shabby. As we said before, these REITs have not performed well in the bear market, and that is a very normal characteristic of a REIT. Once we do move into a bull market, hopefully by the end of this year, I'd like to see that, we will see much better performance from REITs going forward. So they can definitely be a reliable source of passive income for your portfolio. Keep the learning going. Watch my video on covered calls or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.